Hello everyone. I saw some of you posting question about this chapter, financial statement analysis. As you see that there are so many ratio, right? And those are the standard one. Now, people or financial analysts can create their own ratio to meet their need. So I don't want to try to go through all of those ratio, but instead, I will show you an example of how people use the ratio. Okay, so first of all, to get the ratio, we need to have the financial statement. Here's one of the place you can go to. You go to Yahoo Finance or Google Finance. In this case, I go to Google Finance. Okay, I type the ticker of say Apple. It is AP. I mean AAPL. So you search. Here's you have the information about Apple stock price, how it move over time, things like that. The major competitor like you have Microsoft, the HTC, Sandy, Samsung, things like that. Okay, so to get the financial statement, you can go here on the left panel. You see the historical price and financial. So here, click on financial. You see that there are a few things you can get it. One is income statement. Okay, you can get it quarterly or you can get it annually, or you can go to balance sheet quarterly, annually, or cash flow statement. Okay, so uh, I go ahead and copy the income statement and balance sheet of Apple, quarterly data, of course, and then I go to get the information, similar information for Microsoft. Okay, yep, the same thing. Go to financial. Yep, I copy and paste things to Excel, income statement and balance sheet, quarterly data. So here we go. Uh, here. Of course, the financial statement is long and contain a lot of information. So for the purpose of illustration, how to use financial ratio, uh, I just select few of them: revenue, cost of goods sold, operating expense, net income. Now from those few, yep, I calculate the net profit margin. The net margin, as you remember, or you may want to look at it up in the book, it equal to the net income divided by revenue, right? The second, I calculate the gross profit margin. Gross margin equal to gross profit divided by revenue. How to get gross profit? You take revenue minus cost of goods sold. You get the gross profit. Take that divided by revenue. You have the gross profit margin. The same thing I do for Apple. Yep, here's for Apple, that section. Okay, I copy the same thing and then I calculate net profit margin and gross profit margin for Apple. Okay, and also I work on current asset, current liability, and total asset. And out of that, I calculate the current ratio for Microsoft. What is the formula for that? Okay, current ratio equal to current asset divided by current liability, right? I do the same thing for Apple. So here I try to focus on analyze the profitability of those two companies. So now we have let's look at the net margin ratio. How can we use it? The net profit margin here uh, at the second quarter of 2013 for Microsoft is 24.95%. Okay, what does this mean? There are different ways to interpret it, but the easiest way is that out of $1 sales, out of $1 of sales, Microsoft get back net 24.95 cents or 24.95%, right? So one way it is, look at that. Of course, the net profit margin tell you something, right? $1 sales, Microsoft get 24.95 cents in net profit. So it has some meaning. Okay. Another way to use the ratio is to compare this ratio over time within the company, how the ratio change. So as you see here, from 13 to the second quarter of 14, 24, 28, 26, 27, and it dropped to 19. So not very good, right? Even though things seems to be increased, but suddenly it dropped in the last quarter, the second quarter of 2014. Okay, so it is not, the trend is not very clear, but it is the second quarter is really, really bad. Yeah, okay. People can use the ratio to make the comparison between the two firms. It is the most important, I think it's one of the most important use of ratio, making a comparison. You can see that it is difficult for us to compare the net income of Microsoft, say 4965 versus Apple in the same quarter of 6900. And then, like, because the size of the two companies are different, sales are different. Look at the sales here, you see, it is 19,000, right? And for Apple, it's 35,000. The sales is different. However, when we scale everything by sales, look at the net profit margin. Now we can compare. Look at that. 2013 net profit margin for Microsoft 24 is better than Apple 19%, right? However, in the last quarter of the most recent quarter of 2014, Microsoft profit margin is 19, and then compared to Apple of 20. Okay, so over here I make a chart instead of looking it one by one. This chart here, the first one here, tell you the difference between Microsoft and Apple in terms of two things. One, net profit margin. The other is gross profit margin. So you can see that consistent with what we just observed in the net profit margin. The difference here, the red bar here, show you that, okay, over the 4 quarter, 1, 2, 3, 4 quarter, up to the quarter 1 of 2014, Microsoft did a better job than Apple in terms of net profit margin. The difference is positive, right? A positive 5%, 7 or 8% here and there. But suddenly in the second quarter of 2014, Microsoft underperformed Apple. So it is not good. It is not good here. Market is not happy with when they see that. Okay. In terms of gross profit margin, you see that the difference over here. We are talking about the difference. So the absolute value is gross margin for Microsoft is 71, 72, 66, 70, 67. Pretty high, right? Compared to gross profit margin of Apple, say 30-ish, right? Up to 40. So gross margin of Microsoft is way better than Apple. And the difference, you can see that here, the difference. The difference in the first 2 quarters is about 35%, and then in the next 3 quarters is more or less 20 to 30%, right? Okay, so gross profit margin, Microsoft does very, very impressive. However, when it comes to net profit margin, it is not that impressive anymore. And especially in the last quarter of the most recent quarter of 14, it is really bad. So using as a ratio to compare the performance of the firm over time is one way. Compare the performance of firm with other similar firm is another way to use the ratio. Now, by now you may wonder what happened. You know what? Gross profit margin really, really high. Way better than Apple. Why net profit margin of Microsoft is not, up to that level? Why, in terms of net profit margin, Microsoft only outperformed by 5%? Why the gross profit margin outperformed by 35%? Okay, I leave that question to you. What explains that gap? Okay, you can think about that. There must be something that account for the difference from 35 up here to 5 up here. There must be something that eat up all of the gross profit, right? loosely speaking, you outperform me like 25% on gross, but then you underperform me on net. What happened to you? You know, okay? So it is the profitability, one aspect of it. I want to look at the current ratio. The current ratio, what does this mean? In terms of formula, it equal to current asset divided by current liability. It belongs to the liquidity group of ratio, right? Okay. So over here in the second quarter of 2013, the current ratio for Microsoft is 271% or 2.7 times. And it is pretty large here, 2 or 3 Ds here, when it comes to Apple, it's 147%, 163, about more than 1.5 times, right? More or less 1.5 times. So very clear that the current ratio for Microsoft is higher than the current ratio for Apple. Okay. Now, higher is better or higher is worse. Of course, it depends, right? Profitability, higher is better, definitely. Of course, other things equal. Okay, now, what does this mean with the current ratio of 271% or 2.71 times? It means that for $1 of short-term liability, Microsoft have $2.71 in current asset, which is the most liquid asset. It means that Microsoft have well enough liquid asset to pay for the short-term liability. So the liquidity condition of Microsoft based on the current ratio is really good. Does it mean that the Apple is bad? I don't think so, right? For with the ratio of say 1.7 or 1.5 times or 147%, it means that for $1 of current liability, of short-term liability, Apple have $1.4 of liquid asset to cover. So it's very good. It's also very good, right? So both Apple and Microsoft have very, very good liquidity condition based on the current ratio. Look at the difference between two. So here, the blue bar is the current ratio for Microsoft. The red bar is the current ratio for Apple. Most notably, for those two companies, the current ratio are well above 1. So it is very, very good. Yep. You don't want to see the current ratio way too low than 1. In this case, for $1 of short-term liability, you have to pay soon, You don't have enough liquid assets, so you may fall into a little bit trouble, right? So now both of them are above 1 is good. So think about that. Here's a difference. So the line here, the dark line here is the difference between Microsoft and Apple. It looks like the difference is kind of narrow, right? Drop. I mean the gap here is bring down due to two things. One, the current ratio of Microsoft in the recent quarter dropped from up high here to 2.5 times. And at the same time, the current ratio of Apple is rising from say 1.6 or something, go up to like 1.8. So the gap here is dropped. Now the question you might want to think of is, okay, is that necessary for firm to maintain a very high current ratio? May not necessarily, right? Yep, may not be the case. Yep. So if you combine those two pictures, profitability and the current ratio, it may tell you something. It may give you some idea. It may not be exactly correct. You may have to do further analysis. But one thing people may wonder is, okay, why Microsoft keep so much in terms of current assets? The current asset include what? Cash, account receivable, inventory, and some other. The three. So high current ratio may because you have too much cash. Now it is not always good. You have too much account receivable. It means How about your collection productivity? You may not be efficient in terms of collecting the debt that come due. And the last one is inventory. Now, if you have too much in inventory, it may not be good, because it could means that you cannot sell as much as you want, or your product is out of date. Now, these may be one reason why you see your net profit here pretty low, compared to Apple, of course. To a certain extent, you can say that, okay, Apple do a pretty better job in terms of managing the current assets. It may be because they manage their cash better. They can find a good way to use their cash. They may collect their account receivable better, or they manage their inventory better in the sense that they keep it low, sufficient to support sales but not too much. Okay, so of course it is just a very preliminary brief um, analysis of the two companies, just in order to show you how people use the financial ratio. Yep. So I hope that it may help. Okay, it's 16 minutes. Sorry about that. Thank you.